Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
In summary, all right, IV is not structured uniformly within a month or from month to month. By using intra-month skew, traders can better select directional spreads. And by using intra-month skews, traders can enter profitable non-directional and directional spreads. Okay. Do we have any questions? I noticed it was not, wasn't my smoothest of presentations, but I think you guys hopefully saw the point on what was really there. And understanding how volatility is going to affect your option trading is absolutely essential to becoming a successful trader.
Hey, Mark, let me ask you a question.
Sure.
Do you think it's more important to have an overall forecast on your asset and then look at the options to see where the skew, or you look at the skew first and then try to formulate where the asset's going and then come up with a strategy? Or is it sort of both?
I think, I'm a combo of both, all right? One, when I'm trading, my directional trades, the first thing I do, and this is harder to do in FX, is I'm a big paper reader. So I like to kind of sniff what's going on in the paper. But what I like to do then is really research what I think is going to happen, and what my opinion is. Then I take a look at the volatilities and the structure of the different months, and I go through and I try and find what is the cheapest, way to do what I want to do. Okay, so to answer, I probably look at the asset, then I look at the options for a directional bet. Okay.
Right.
All right. How do you determine if you're paying too much for a debit spread? Well, if you end up losing money, you paid too much. No, kidding. That's a really difficult question. But here's what I would say is that, ways you can figure out whether you're paying attention to debit spread. A product like Live Vol Pro can really give you some clues. And back to our Canadian dollar, when I was messing around with this skew, I'm just going to go to a month. There are, looking at skew over a month, over a year, over several years, okay, you can really determine, where should different spreads be priced relative to the options themselves. And if you watch how skew is shifting, okay, you can really kind of figure it out. Now, when I'm trading indexes, which again is really my strength, when we were on the floor and I was trading with the SPX trading firm, I actually knew day to day where the 2 delta put was trading relative to at the money, where the 10 delta put was trading relative to at the money, where the 25 delta call was trading relative to at the money, where the 10 delta call was trading relative to at the money, and then of course obviously at the money volatility skew. And I kept track of that constantly every day. And when I'm determining trades, debit spreads, credit spreads, condors, butterflies, calendars, all right, I'm looking at implied volatility. I'm looking at how is the volatility term structure, how does volatility term structure look, how is volatility skew set up within this given trade, okay? And what trades are going to be favorable based on what I'm seeing. And if I've got a bullish opinion in CDD or in, SPX, it doesn't matter. If I see a higher upside skew, debit spreads are going to be a great trade. And if I see a really flat skew, all right, the credit spread is going to be a much better trade. All right.
So, Mark, Tina has this question. I think maybe it's not the same exact question I just asked you, but I'll just repeat it. Don't you want the skew to be low to begin with in the trade if you're trading non-directional? I guess what she's saying is, paraphrasing, do you like to trade with or against the skew? And I guess you just said that you rather trade sort of against the skew in most situations, correct?
Well, I like to use the skew to my advantage,
Right.
you know. Okay. And, you can trade with the skew while still using it to your advantage is one of the neat things.
True.
And that is really my approach, okay? So what I like to do is say, okay, there's a lot of people that think this stuff is going up, and they're bidding up calls. Well, what's the easiest way to get long deltas and sell upside? Call spread, right? Call spread. Put spread works. Selling a put spread works too. As we all know, they're actually the same thing. I read an article where they actually presented a call spread and a put spread as two different, and credit spreads and debit spreads as two different things. It's kind of an insult. But if somebody presents the credit spread and the debit spread as two separate trades, run, do not walk from that person. All right? You probably know more about trading than them. Peter is asking, what about the dollar against the majors in 6 months?
Good day, Peter.
I love it. How much weight should we be placing on theoretical values? Theoretical values only matter if you are deriving your own model, really. Steve, would you kind of tend to agree with that? That if you are deriving your own model and you are inputting your own volatility curve, okay, then theoretical values matter, all right? For the general public like you, all that you care about is where things are trading. Now, there is one exception to that rule, all right? If you see a mispricing out there, that's when theoretical value matters, okay? Things like you can sell a credit spread for $5.10, or the call spread is trading $3. You can buy the call spread for $3, or you can sell the put spread at $2.10. What are you going to want to do there? Wait a minute, call spread you can buy for $3, or you can sell the. Yeah, that's right. Sorry. Those different types of trades. That's where understanding theoretical values matter. I mean, the stuff that, first off, I'm guessing a lot of you use some of these, if you look at the different trading platforms out there, most of them screw up cost of carry on such a phenomenal level, okay, that it makes using theoretical values and implied volatility impossible. Seriously. Steve, I'm sure you've seen it.
It's very hard to find somebody that knows the cost of money precisely.
Yeah, and that's one of the reasons why I like Live Vol Pro. The only vols I will look at and consider to be acceptable implied volatilities is if I look at a line, I look at a strike, like in this case the 103 strike, and the put and the call have the same implied volatility. Okay? If you're not seeing that, you're not looking at reliable vols. Any other questions?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.